All right. Let everybody finish up grabbing your food and drink. Get settled in. I know it's kind of a little bit of an odd room, but we got some seats around. We should have enough seats for everybody. Y'all want to go ahead and get comfy. I'm not sure if anybody's listening to me well, but everybody's just having fun, you know. Oh, that's a big difference when you close that. I kept turning up the mic going, no one's going to be able to hear me. What would you like, sir? All right, I think I had an opportunity to meet with pretty much everybody. I know some people are just now coming in, but I figured I'd introduce myself. My name is Mark Conley. Many of you obviously know our firm. We've got a lot of clients here. I know we have some people who are just kind of engaging and looking into Wealth Design Group. We are a financial advisory firm. We're located over in the Galleria area. We've got about 50 advisors. We are one of the largest boutique planning firms in Houston. There is actually a tasting room right over by the Galleria office, which I think a couple people actually ended up going there first before they made it here. So hopefully you made it here. In full disclosure, before I get started on the presentation for tonight, I do like to let everybody know that I am a fighting Texas Aggie. So some of you may have to leave the room at this point, and some of you will still listen, quite possibly. But I graduated from Texas A&M University and basically got into this business, and I've been doing it now for 16 years. My technical titles, I'm a CFP, it's a Certified Financial Planner, and really what we do at Wealth Design Group is we try to educate our clients, and this is one of the types of events that we do. We have an opportunity to give good information, that's valuable information that you can use in your everyday life when you're dealing with your finances. So as you can see, the topic that we have for this evening is, oh my goodness, Obama was reelected. Should we get out of the market? Now, this is always an interesting presentation, just so you know a little bit of who I am. I am a fiscal conservative, so many of you know that I've not been getting my way politically as of recently, so I'll say that in full disclosure as well. But tonight really isn't about politics, so what you're not going to get from a standpoint of, you're not getting Fox News, so I'm not going to tell you that, the United States is coming to an end and you need to get all your money out of the market, death, doom, and gloom. I'm also not going to be CNN, which is going to tell you, we all need to get in a big circle, hold hands, and sing Kumbaya. Everything's going to be utopia, all right? Really, what we're going to do is we're going to present some facts, because the questions, when the election happened, and you had some people who were very happy, and you had some people who were very angry. Obviously, we're in Texas, so I would assume the majority of people in here did not vote for Obama. I know there are some that did, and it's okay. We're not raising hands or anything like that. But there was a lot of concern, and so since that question was coming up, our firm felt like, well, we better address this. We better talk about the fear that has been coming forth since this happened. And what we're going to do is we're going to present facts. We're going to show you some historical facts. We're going to talk about recessions so that you can, y'all go ahead and come over here. We got wine, appetizers. But the bottom line, that's what we want to do. And we do realize there's a lot of financial firms that are out there, so we very much appreciate everybody that's come to this event. We try to make them fun as well, so good wine, good food. This is actually my first time at this tasting room, so kind of liking it. It's pretty cool. But we talk to our clients. We say, hey, what are the types of functions that we could do that would encourage you to engage your financial plan more often? What are the things that we're doing at Wealth Design Group that are helpful? The main things that we get back are that we have honesty, integrity. We have a lot of knowledge of the financial markets, but we share that knowledge. This isn't we're not a firm that's just, give us your money and we'll take care of everything. We believe that you've got to engage because, sure, when markets are good, we saw U.S. Markets and international up, 19% last year. Well, everybody's happy, right? But we all know that that won't always be the case, and that's why we think education is important. We believe in always doing what is in your best interest, not what is in some financial institution's best interest. A lot of times, really what that means is we don't represent any financial institution. We're going to look for the companies that are strong, the companies you can count on, the companies that are going to be there in the future, and that's who we present to you as clients, for those of you that are clients here, as well as that's what we do for you, for those of you who are kind of checking us out tonight. Your money's not with Wealth Design Group, Mark Conley. Your money's going to be with big national firms that we've looked at. We found that they are strong companies that we can depend on. They've got the right strategies. It is our commitment, it is our job to present to you uncommon strategies that are appropriate for people who are high-income earners or anticipate being high-income earners in the near future. And that's really part of our role, is to show not what's probably applicable to 95% of the population, but what's applicable to 5%. So that's part of the role that we play. We believe in teaching you more about money than what you currently know. Everybody in here has a different level of expertise. There's probably some people in here that know quite a bit. There's probably some people in here that I don't know anything, okay? But that's the role that we play, is we play the role of a coach, and we want to have education. We want to help you get to the point that you can know more. We do two functions every month. One function, which obviously you're at tonight, is what we call our coaching session, and that is a different topic each and every month. Then we do one called the Myths and Truths of Investing. Some of you have attended it before. If you have not, please do come. But that's where we focus on some of the Wall Street myths, the traditional style of investing that no one's gotten any real return over the last 2 years, and we show some truths, some simple strategies that you can put in place so that you could and can be delivered returns, whether it was in the past or in the future. And that's part of that ongoing education that we believe in, and that's part of our commitment to our clients. As far as what we do as a firm, aside from that, we're financial planners and financial coaches, so we're helping with life insurance and making sure your wills and trusts are set up, disability insurance. Have you looked at your long-term care insurance and reviewed your protection plan and made sure, hey, if something goes wrong, you or at least your family is going to be okay? So we're going to look at that. We'll look at debt, mortgages. How do you become debt-free as quickly as possible? And then we're going to look at the more advanced strategies such as portfolio design. Again, that's really what the Myths and Truths presentation is about, is how to properly design a portfolio for your 401ks or investments that you're doing outside of that. Then we do legacy planning, talking about what you want to be for the next generation. And so those, that's really everything that we do as a firm. Kind of give you a quick summary of that. I would say the bottom line, the benefit of what we do is we'll help you get organized with everything that you're doing financially so you can be confident what you've chosen is the right things for your particulars and your family, so you can have security in your future, so you can get to a point where you have peace of mind. And, at the end of the day, how do we do all that? Well, there's three things. One, we use a software package, an online software package, where we can set everybody up on a financial plan that gets you totally organized, okay? If you have not seen this or you don't have that, please ask whoever invited you to show this to you. It's a very powerful tool so that you can see everything, no matter, you've probably got the junk drawer approach, many of you, so you can see everything where it is. So I encourage you at the end of this, we'll pass out some cards, and if you haven't seen that, check yes on the card. We'd love to show you an example of it, and you can see if it's something you'd like to hire us to help you with. Number two is taking some of your money that you're saving for your long-term goals and showing you strategies where you can put that money away. You can get an ironclad rate of return regardless of what happens in the economy, and that will address a lot of the fears that some of us have. And then if you have not looked into those strategies, a lot of times you're getting 4 or 5% tax-free, so that might be the equivalent of a safe rate of return of 7 or 8. So those are the types of uncommon strategies that we present. If you have not looked at those, talk to the person that advised you. You should look at it. Check yes on the card at the end. And then lastly, which is really what tonight's presentation is more about, and that is money that you are willing to take some risk with, calculated and prudent risk. How do you get the best rate of return that you possibly can? How do we figure out what's going on, what impact the current events are going to have on that money to get the maximum rate of return? That's really what we do. Organizational plan, save money, as well as getting maximum return for the money you're willing to take some risks with. So with all that being said, just kind of as a quick opener, as quick as I can make it, and then we get long-winded. I got a little bit of a video since we're doing a political talk. Let's see if this is working from over here or not. You have to come closer. Or is it even on? It is on. All right. Surely not. Let me stand over there real quick. Technical difficulties. There we go. All right, so we got some good gas here.
My state of the union, my state of the nation. Our national interest ought to be to encourage the best and the brightest. Chuck Graham, state senator, is here. Chuck, stand up. Chuck, come and see you. Oh, God love you. What am I talking about? I tell you what, you're making everybody else stand up, old pal. Thank you very, very much. I tell you what, stand up for Chuck. Recently, I received a letter from Mafia to Okamura. Too many cops are getting out of business. Too many OBGYNs aren't able to practice their laws with women all across this country. We're going to show in Oregon and Washington and Michigan, and then we're going to Washington, D.C. to take back the White House. Yeah. It is just wonderful to be back in Oregon, and over the last 15 months, we've traveled to every corner of the United States. I've now been in 57 states. I think you all know what to go. But in Delaware, the largest growth in population is Indian Americans moving from India. You cannot go to a 7-Eleven or a Dunkin' Donuts unless you have a slight Indian accent.
Hey, do you mind just closing out the Windows Media Player there? And it should go back to the PowerPoint. There we go. Let's see it. All right. Yeah, that's good stuff, definitely. So obviously, I think some of the questions that everybody has is, you know, with everything going on, QE3 taxes, that was a big deal. You know, what was going to happen with the state taxes and everything that's happened. How is that going to affect your retirement investments? Now, I think when we do some happy hour functions like this, this is the typical conversation that most of us see happening, and that is we're having a glass of wine and we're saying, hey, what do you think about this? Because of this, are you in the market or are you out of the market? What stocks are you buying? And that's the typical kind of fun conversation. But really, there's a deeper problem that's going on there because this is extremely complex. This causes a lot of fear and uncertainty, and it is human nature, if you don't have a plan to address it, that you will inevitably make mistakes. So it's important that we have functions like this and get this stuff out in the open and look at the reality, not what's being pushed one way or another by the media of what the situation is. And so here's some points that I want to talk to you about. Expectation about the future are in today's market price. I think sometimes it's very difficult for people to understand, but where the stock market is priced and where everything is where it is supposed to be priced. That is, supply and demand that determines what something is worth. And because it's already in the price, all those fears and concerns and the things you just saw is already priced in there. The expectation of what is going to happen is in there. Now, I do find it interesting, though, that for whatever reason, we all feel compelled that surely that can't be true, so I'm going to either analyze how wrong the stock market is and find the few stocks that are going to be the buy that nobody seems to know about, or I'm going to hire a mutual fund manager or someone who is going to do that for me, because surely they know that the stock market is priced wrong. One of the data points I like showing people is if you actually look at the performance of stock-picking mutual funds or money managers, a lot of people are unaware of the fact that they only outperform what the market does as a whole 30% of the time. You want to know why? Because the market has it priced right. Okay? Does it change? Sure. Does new information come out? Sure. But that's why. You're actually better off 70% of the time if you just bought every stock. And if you look at the data and you realize that's the truth, you probably quit going about picking your stock pickers, or maybe you're doing it on your own using the old traditional system of doing what? Looking at a track record. And another example of that would be that there's a correlation in my second point between recessions and the stock market performance. See, we as humans, we're always looking for the correlation, right? So that we can see the pattern, so that we can then take advantage of it. That's what we do, okay? Nothing's wrong with that, but the problem is you need to use your thinking mind, and you need to actually look at the data and realize where there isn't a correlation. For instance, because people say, all right, Mark, when they're presented with the facts, which obviously I'm not showing that this evening, but once money managers and stock pickers only outperform the market 30% of the time, well, then you're faced with a why on earth am I still doing that, unless you think, well, I'll just give them the 30% to do it, right? And the only way to do that is what? Look at the past performance and assume that because they did it in the past, they'll do it in the future. It's a fun game to play if you ever look at past performance and then results moving forward, even with some of the biggest names in the financial industry. And what you'll find you won't like, and that is that past performance doesn't help you at all. You know, it's a missed presentation. Sometimes we do a quarter flip game, which we're not going to do here, but it's kind of a point that I make. Okay, quarter flip, right? 50% chance of getting heads. So if I ask each person in this room to flip a quarter and get heads 10 times in a row, how long is it going to take you? Probably a really, really long time, right? But if I ask an entire football stadium of 100,000 people to do it, someone probably get it on the first try. It's just the law of large numbers, okay? Now, if that person that got it, would you bet they're going to do it if we played the game again? Of course not. That's insane, but that's in fact the way that most investment advice is given, is looking just at a track record performance and assuming it'll be it'll happen in the future. Now, mind you, I realize that it's a statistical fact as well that if that person did it 10 times in a row, there's going to be someone out there that you can go, but look at this track record. They got it 10 years in a row. You can't tell me that's just random. When there's 100,000 money managers, it's a statistical fact that somebody will have gotten it 10 years in a row. Still has absolutely nothing to do with if they'll do it in the future. Markets can provide positive returns even during periods of poor economic performance. You aware of that? Some of the data we'll look at. I think it's very interesting because if the concern, and these are most of the concerns that I'm normally hearing, is because Obama's not pro-business, okay, because Obama has more of a socialistic type view in some of his social policies, that is going to hurt the economy, and that's why I've got to get my money out of the stock market as quickly as possible. We can, after the presentation, we can sit around and have some drinks and have our political debate about if that hurts the economy or not. But what I'm here to present is the facts of what does that actually do to the stock market, okay? Timing the market is very, very difficult. So we're going to play some games tonight, and I'm going to do some different drills where we're going to try to time the market. The last 20 years, if you invested in, say, the S&P 500, you would have had about a 7% rate of return over that time. That's 5,040 trading days. If you just missed the 40 best days out of 5,040, you actually got a negative 2% rate of return every year for the last 20 years. Market timing is a dangerous game to play, and it actually has more of a chance of failing than it does of being successful. So we'll look at some situations for that. Okay, so let's kind of look at some of the data and have fun with this. And if someone has some questions we go through, feel free to ask. This is measuring the GDP. So this is how we're typically trying to get an understanding of how well and how good the economy is doing. And then the red lines basically are showing a recessionary period, which of course, you know, you look at this last recessionary period that we were all just crying, the end of the world, this is terrible. You know, we didn't have to deal with some of this stuff back here. Okay, those are real recessions, real depressions. But with that being said, you know, one of the other things that's funny is if you talk to a bunch of economists, they can't even agree as to sometimes what the definition of if it's a recession or not. But let's throw that out the window, and let's say that you somehow could predict when recessions will be, which, by the way, is the conversation that so many people have with their advisors, where the advisor's going to say, well, I'm thinking in 2013, based on this data, that we're going into a recession, therefore we're making this market mean. People predict this kind of stuff all the time, but when you take a step back and think about it, you know, it's no different than looking, you know, who's got the crystal ball, right? So what we did is we went back to 1904 here, and that's some of the numbers, and we're showing when we had recessionary period. So that's when you've got negative returns. Let me get my glasses out here. Let's see. Not quite 40 yet. All right. Got a birthday coming up real quick. All right, so if we take a look at some of these numbers here, you'll see when we had a negative or recessionary period, and then so some examples would be 1904. Okay, we'll go way back. We had it was negative 1% GDP, but the returns of the equity markets was 26%. Okay, we had negative 4% in 45, but we had returns of 35%. 91, we had, you know, a negative, just very flat, and we had a 30% return on the market. Now, not all of these. I mean, you'll see some here. We had 1946, negative GDP. We also had definitely negative returns on the market. But interesting, recessions. When you look at all years, the average return is 8%. So a lot of people, that data is not put forth when we're getting concerned and worked up over what the stock market's going to do. So here's the game I said we were going to play. I always like doing these. So let's say you did know in advance, right? And we were going to take your money, we're going to move it out of the equity market and into cash every time in advance of the recession. Great timing. So what you see here, we've got all, you can see here we've got all the countries, the major countries, and we show if you were, basically what the return would be if you were timing it using our system that you knew in advance, versus if you just stayed in equities, and the difference between those in cash. So I'll give a quick example. In the U.S., if you knew in advance when recessions were, you would have gotten a 6% average rate of return. If you just held the entire time, even through the recession, you'd have an 8% average annual rate of return. The difference is almost 2%, and you would have been in cash about 19% of the time. Average difference, there you go. So, number one, you can't know in advance. And number two, here's what normally happens. 2008 hits, you lose all your money, and you go, oh my gosh, it's a recession, get me out. So the normal reaction is actually you take the hit and then move. You don't know this in advance. And so when you look at this, you realize there's not a correlation between recessions, depressions, and what the market rates of return might be. So albeit, there may be a serious concern about where the country is going. I mean, everyone agrees that we've got some serious debt problems that are going to have to be addressed. Everyone understands that there will be a different business environment. We're going to have to deal with that. But when it comes to your investing, there's not a correlation. And that doesn't mean I'm saying if there is a recession, you're going to make a ton of money in the stock market, okay? Because you could lose. But I am saying that you can't say because of that, this is what to expect. In fact, the data actually shows it's been the opposite of that. But still, there's not enough data, though, for, I think, anyone to make a meaningful statistic correlation between the two. But the point is, a lot of people are unaware of that, and that doesn't get advertised. The other issue that we're faced with is not just the business environment, recession, and companies making money, but it is, in fact, that a lot of people they think the agenda of having health care for everyone, the agenda of offering lots of medical and drug benefits and Social Security is a move towards socialism. So that means the markets are going to crash. So what I'm going to show you here is I'm going to take a look at all the countries, and I'm going to give you a ranking of what we consider economic freedom. And we're going to talk about what rates of returns have we realized in the stock market. Because one of the things that those of you who work with us understand is we definitely believe in a global economy. We think there are opportunities always. You should invest globally, not just in the U.S. because there's great opportunities. So we're always going to look at that. And here's kind of the way that we measure which countries are free and which ones are not. Rule of law, property rights, freedom from corruption. We're looking at limited government. We're looking at regulatory efficiency. So there's business freedom, labor freedom, monetary freedom. And we're looking at they have open markets. Okay? And those are the factors that we put in here to gauge what's a more free country versus a less free country. So here's the map. Obviously, you can tell, the green is more free, and then as it gets more orange versus the red are the less free countries. So the thinking, obviously, is a move towards socialism is necessarily going to be terrible for investment. By the way, this presentation, as I was kind of looking through it to prepare for tonight, it is kind of frustrating, to be honest, because some of it goes against what I would think would happen too. But it is the truth, and that is our job, is to present that. Because, I have to separate my political talk I may want to make versus the facts that are presented in the data. So what we've got here, Heritage Foundation has put this together, and it shows the top 5 most free countries versus the top 5, or bottom, whatever you want to call it, they're least free. Okay, so Greece is the least free of the free, Hong Kong being the most free. And this is done in 2010, emerging, and then it shows an emerging, so developed and emerging. So what do we see? Okay, let's see if this goes, if we can show the number. No, it doesn't. So we've got the least free is the top number. You would have actually had more growth investing in the least free countries. Now, there can be many reasons for that. Sometimes it's just a simple fact that right now they're not free, but as you put in free markets and they become more and more developed, they will become more free. That's always my hope, that countries become more and more free, and that's something that I think most people believe in and hope for. So that can be part of the reason that's there as well. But yeah, define free country. Yeah, really. And that's kind of why I was showing this. Basically, what they did, the Heritage Study, what they did is they did a ranking of rule of law, limited government, regulatory efficiency, and open markets, and basically came up with a number system on those rankings of those 4 factors. And the more beneficial that it was to be free, they gave it a better ranking, and that's why you'll see that it has the numbers. So, Ireland here ended up with an 81, and that's the mathematics that they put behind defining free. They felt like those 4 factors is what determines more free versus less free. So, trying to put a science to a very difficult question, obviously. But That's how they came up with it. But if you look, this is the developed markets, less free, made more money. You look in the emerging markets, less free, made even more money. Now, there's a relationship there that people need to be aware of. Obviously, when you're taking more risk and it's more uncertain, it's an interesting thing that over long periods of time, you're delivered more return. Prudent risk will tend to deliver more return. And if you look at an asset class and that's not the case, it's extremely volatile and risky and doesn't always deliver those better returns, that's probably not a good asset class to own. And that's one of the first things we do when we sit down with a client is we do an x-ray on all the investments in their brokerage accounts or in their 401ks to take a look at the risk in the portfolio, the return that it's getting, to see if the risks being taken are in fact prudent risks for those extra returns we're getting. But this is what we would expect to see. And then kind of a step beyond that is then you can start taking more conservative assets and mixing them with those riskier assets and actually get higher return and less risk. It's called modern portfolio theory, something that we do.
The thing on the riskier stocks is across all the portfolio, or is it just separate?
Right here, what we're basically, this is showing $1, and it goes back, what's the year we're going back to there, and this is 98. That's 98, okay? So what this is basically saying, had you been in the least free countries, you would have had a higher gain than if you would have been in the...
Yeah, but my question is, if you invest money in any stock or specific stock?
Okay. The question is, you know, are we talking about some specific stocks that got that return? When I show these charts, I'm showing the entire market. So every single stock within that market. Why do I show that? Because if that beats stock pickers and money managers 70% of the time, that's what I want to invest in anyway. I don't play the game of try to find someone who says that they're a financial guru or genius, because the data is out there, and they're not. And in fact, they cost a lot more than it does to buy appropriate chunks of the market. So I am talking every stock in those markets. And now there's efficient ways to do that. You know, obviously, there's a little bit more to it than that, than developing a truly efficient portfolio, but I think that'd be a whole nother, that'd be an hour talk. So, how are we doing on that? Okay. So what I'm showing here is the GDP, okay, so, and GDP is linked to higher income. It is linked to better longevity, lower infant mortality, better education, increased life satisfaction. All those things are awesome. That is why I absolutely believe that we should all do things that we can to make the world a better place, because we want freedom so that people can live better. I mean, that is part of the role that we as humans should all be playing in some fashion. But with that being said, it just isn't linked to stock returns. So the fears that you see of what you hear on the news, that does have something to do with the economy. I'm not saying that. But it may or may not impact your portfolio the exact same way. And if you try to guess and move in or out when you think it's right or wrong, or even worse, you're letting someone else guess for you, you'll end up losing in the end. I mean, study after study, and in my 16 years, I've looked at timing system, or a lot of times they call it tactical allocation, where they're going to move. The same people that only beat the market 30% of the time also are going to somehow tell you which sectors and which areas you should put your money in. I mean, it's crazy that we go about our business, but that's kind of what the media in Wall Street has created, is the sexiness of that type of investing, where if you actually go to a more academic view, you'll find a lot more success, better returns, and at the end of the day, more money to do the things that you want to do. So, all right, I'm going to run through this last little bit pretty quick, because I want to do presidential returns. So we're going to look at Democrats and Republicans and how well that the market fared during the different regimes, okay? So we've got Coolidge here. You can't see the numbers, so let me stand up here. All right, so what we've got is, the way I'll give it is, it shows what $1 during their regime basically would have grown to. So we got Coolidge, dollar went to $2.09. Okay, we got Hoover, $1. You finish with 28 cents. So not so good there. Roosevelt, $1 to $4.61. Truman, we went up to $3.10. Eisenhower went up to $3.04. Yeah. We've got Kennedy, $1.39. Lyndon B. Johnson, $1.66. Nixon, went from $1 to 91 cents there. Ford, $1 to $1.50. Even Jimmy Carter made some money. Look at that, $1 to $1.55, right? Got the Gipper, $1 to $3.80. HW, $1 to $1.79. And then we had Clinton. I did not have sexual relations. Clinton, $1 to $3.56. Ooh, George, not so good. $1 to 79 cents. And then we've got Barack Obama, $1 to $1.48. And this actually shows the growth of the dollar. The S&P 500 from 26 would have grown to 2,700, all the way up to, if you bought all small value companies, it could have grown to $114,000 over the total period of time. The market performs, obviously, whether it's Democrats or Republicans. But which one does it perform better at if I take all that and put it together? So here we've got the GOP, all right? Total return of each of those presidents, you can see who the winners and losers were. Shows that growth of the dollar. And then this shows what their annualized rate of return and the total number of years. GOP did 753,000 total, or a positive return of a little over 5% per year. Not bad. I don't like this next slide. All right, here we go. Okay. Here's what the Democrats have done. An average return of almost 14% per year and 30,000% overall rate of return. Okay. Now let me qualify a couple of things. We've got, this is like 15 regimes, right? Statistically speaking, you have to have 64 of a sample size for me to say that there's really any value to the information I'm showing you as far as presidents go. So in about 200 years, we'll meet back here and I'll tell you if Republicans or Democrats, actually there is a correlation in the rate of return. But it is interesting to see. What I can say is you can't say that because of some of the policies of Democrats that necessarily means that the returns are going to be negative. You can't say that. No, you can't say it's definitely going to be positive either. All right? I mean, take it for what you will, but those are the real numbers. And this is what you're going to see. And you're going to continue to see. Obviously, Fox makes it sound a little bit worse, and CNN makes it always sound a little bit better. So you just need to understand media is good. You should listen to it. You need to be informed. You need to motivate people to vote, whichever way that it is, what they believe in, because we do need to make the changes that are necessary. Everybody agrees we need to balance the budget. That is important. But keep in mind, if you were a media company, how do you make money? Well, you get money from politics, but you got to get advertisers, right? And the more people that watch my show, the more advertising dollars I'm going to make, right? And if I say up next why the market is crashing and America is going to crumble into nothing, you're probably going to watch. If I say up next a sound investment strategy based on academics and statistical research, nobody's watching that. So bear in mind, they're always going to prey on either fear of loss or the greed of how much you're going to make. It doesn't mean it's not, I mean, in my job, obviously, I have to watch this, all day long. I've got to learn more and be aware. But just put a little bit of a filter on it and understand where they're coming from so that you can make good use of the information, not panic use. Because here's what you'll see. The new deal. This is in 2008. We have, I like that one. This is going to hurt. 2009. Out of work in America. America's vulnerable economy. Drudge report. Big number. Whatever. Okay. We are all socialists now. This is the real stuff that you're seeing, what you'll hear. What we spend. They're real problems. Food stamps, welfare, national debt. We're going to hear about this one constantly. Unemployment, terrible. Okay? But if I go Obama and I go through all those articles, all those things, here's what the market did over that 0.9. You know, on each of the market indexes. So there's the S&P 500, $100.49, $1.60. You know, these are the different market index, small caps, values, all the different indexes that you should put a portfolio together properly to get maximum return. And we've all seen that's what's happened. I don't know what's going to happen this year. I don't know if we'll see another 2008 or if we'll see another 2012. Nobody does, by the way. And anyone that tells you they do and gives you a bunch of fancy data, run as fast as you can. Because remember, yesterday on TV or last year on TV, someone was on there that gave a bunch of fancy data on why the market was going to crash. And someone gave a bunch of great data on why it was going to do well. One of them gets to be right each and every year and say, I told you so. And everyone forgets about the other person. That's how it works. Okay? Performance of our portfolios going back to 93. Okay? You'll see here, this one, that's the consumer price index. Then we've got income and growth. So income and growth, this is a portfolio of 25% in the stock market and 75% in just bonds. So that's a very safe, conservative portfolio. 2.1. Then we've got our portfolio that's 50% bonds, 50% stocks over that period of time, 2.8. You can see here, this one's the 75% equity, 25% fixed. The point of me showing these numbers is when everyone tells you there's been no money to be made the last 10 years, that's because everyone's playing the stock picking game. They're looking at past performance. They're chasing returns. They're not buying and holding. Average hold time's like 3.12 years. Everybody says they're long term. Market timing, they ignore the cost of how much it costs to invest. They're not paying attention to reducing costs. Because what are they told? Oh, this money manager, they're so good. Don't worry about what they charge. They're going to make you so much money, right? Probably all heard that. But I show this to show you there is real money to be made if you properly design a portfolio. And then there's the most aggressive portfolio, what that's been able to do over the last 10 years, or 20 years. Okay. Questions up to this point, when you can. Yep. How does the value of the dollar equate into all inflation? Like say I am hitting 100,000 right now on every form that I see. It's going to go to $1 million in the 10, 15, 20 years. Yes. What's $1 million worth? Nobody knows what it's going to be worth. What's $1 million going to be worth in 20 years? And absolutely nobody knows what it's going to be worth. However, there are a couple things of kind of where I think you might be going, and we'll interact. Inflation is one of the biggest concerns that we have, okay? And just to define inflation, basically your purchasing power each and every year of the dollar that you have goes down by however much the cost of living goes up. So when we talk about having $1 million, and we talk about what it's worth in 20 years, well, if you just took your $1 million, put it under the bed, it definitely wouldn't buy what $1 million would buy today, right? Everybody gets that that's the problem. It's really a big problem for those in or approaching retirement as well, because the inclination is to put your money somewhere safe. But if your money is getting 1 or 2% and inflation is averaging 3 or 4% per year, you're actually losing money each and every year. So you, in effect, even retired, have got to take some calculated risk, as long as you do it prudently, so that you can overcome inflation, because that's the big question. What will inflation be? No one can answer that. Okay? Obviously, we can look historically and say over the past 40 years, it's been a little over 4%. If you want to go even further than that, probably average about 3.7%, whatever time frame you want to pick. You can make some rough estimates and then make some calculations that way, and that might be a helpful tool just in seeing how on track you're staying. However, here's the bottom line. Whatever it is, you have got to beat it. Whatever inflation is, you need to make sure you make in excess of that. And interestingly enough, the best hedge against inflation is equity, because inflation is built into equities in and of themselves, because if companies are producing goods and services, right, and inflation's going up, what are the prices for the goods and services that they make? What are they doing? They also go up. So it automatically, equities, yes, they have risk. In any given year, we can see in 2008, you had 100% equities, and an efficient portfolio, you could have easily lost, 37, 40% in 1 year, okay? But over time, which didn't take very long for that to even get recovered, even though every time something like that's happened, we always say this time it's different, and the media makes it more than it is. But every time, any time frame you look at, the best battle against inflation is to take some prudent risks with equities. Equities, by far, show you a result of return premium that you get for the risk taken. Now, a lot of times people say, but I'm just so uncertain about where they're going to go. Guess what? That's why they return the extra return that equities do. Gold is the one that's brought up quite a bit, as using gold as a inflation hedge. Gold has done very, very well. Where gold is going is anyone's guess. Statistically speaking, though, gold is not something that I can show its risk. We measure that by standard deviation, and I cannot show you a return premium that you gain for the risk you take with gold. In other words, gold is essentially a gamble that may make you money, it may not. Gold did not outpace inflation in the 80s. So there's saying that it always is going to be something that outpaces inflation is not actually historically true. Now, the perception is that it will do that, and supply and demand dictates the prices of gold, so we might see that. But what I do know is I can mathematically show the risk taken for equities gives you a higher return than that of inflation. So whatever it ends up being, whether it was 2% or whether it was 5 or 6%, what you typically will see is equities return in excess return above whatever inflation is, depending on the portfolio design, anywhere from 4 to 6% that you'll see in a return premium. So that's the biggest answer that I always say with inflation and how we deal with inflation. Equities is not the only way. I mean, there's lots of other investments that do pay a nice solid return. One of the popular ones that retirees will use are Treasury, inflation-protected securities, if you ever use TIPS. These are bonds, government issued, government guaranteed, that basically pay you a nominal rate of return plus whatever the CPI is. So there's some other inflation protection strategies, whatever inflation ends up being. Any other follow-up questions to that?
Yes, municipal bonds.
Yes.
With the public debt being kind of declaring that certain cities going bankrupt personally, is there, how do you spread your investments over a certain amount of areas so that you're not in one of the places that may default on their bond obligations?
Okay. When we talk about municipal bonds or bonds issued by municipalities, and so the question is, because of the debt that we're faced with and some of the problems, could those in effect fail and you lose your money from investing in those bonds? And the answer is, well, yes, absolutely. Municipal bonds are a little bit of a scary place, especially what we've seen in California, to go, because people see them as a safe type of investment. But there is no doubt there's some serious concern about them defaulting. We've also got serious concern with those in the fact that interest rates are so low that if interest rates go up, that is going to very much devalue the municipal bonds, and the simple fact that they just don't pay a whole lot of interest right now. So, and most people in this room are going to be in the high tax bracket, so that's going to be applicable. But what do we do about it? Here's really what we're seeing. When you look at the risk that you're taking with a municipal bond right now versus the return that you're getting, you're almost better off being in a port. You have equities, and then you just buy U.S. and corporate bonds that are not municipalities with 5 years or less, and you actually end up in a better place than you do taking the risk. Municipal bonds right now have an extreme risk and a low return potential. So for the most part, we steer clear of them at this point in time. When you buy the individual bonds, so we don't have the interest rate risk, and I'm not going to get an explanation of that right now, but if you buy the individual bonds, it's a little less, but then you better be damn sure who you're buying it from is financially stable. I mean, we saw in California where they decided to go ahead and pay pensions and default on municipal bonds. So right now, I just don't like, again, everything is, I always look at what's the risk of an investment, what's the expected return. If those aren't in line with each other, don't bother with it. Bad investment to have in the portfolio. I know some of you may have to leave, so let me cover a couple things, and I'm going to hang out and I'll answer more questions by all means. I want to do what I call the 20 must-answer questions. Did we pass these out yet? No? Okay. Yep. The 20 must-answer questions, we're going to hand them out, and we'll want them, and they're just 20 yes or no, because I would think when you start to analyze what you're doing, how you're investing, why you're doing the things that you're doing, I think you need to ask these questions of yourself, and sometimes you need to ask these questions if you're working with an advisor, if they know the answers to these, because what we're going to find is they're pretty simple questions, and I think everybody in this room will agree they probably should know the answer to it, but they probably don't. And I think that's the way society's been, and a lot of the financial institutions have driven that, where it's just give me the money and I'll handle it. I talked about that in the beginning. You need to have an understanding of what you're doing and why, or at least a good understanding of what your broker's doing and why. Because if they're trying to make economic predictions based upon Obama being elected, they can be making some big mistakes. And that's why we present this information. So I'm going to walk through each of these, and then at the end of the deal, we'll pass out the cards for anybody that wants to meet. We're passing out pens?
Somebody got a pen? Hey, I like the girl. Everybody has a writing.
Oh, they're brand new. Yeah, you got to. I'm going to go ahead and stop the webinar if you don't mind. Real quick.